Well, we're supposed to have more than 20 participants today, but due to some one particular group is having some clash with some exams or something like that, some other exams, so they are unable to attend for today's session. So we should have good numbers in the next session. Okay, so before I proceed, my name is Raj. Okay, so welcome to FM webinar session with Sunmitest, Sunmit Global. I'm not sure what is your background or whether you have done any finance before in your life or in any other discipline or program, or probably some of you would have done under your degree qualifications, right? But ACCA financial management is different in terms of the coverage, as well as certain topics are covered in depth. Certain topics are just touched at the surface. So we will look into the contents of the syllabus. Okay. Just before I move on to the details on the syllabus part, can I know anyone have done this paper before? Has anyone done this paper before?
No, sir.
Oh, okay. All right. There's 4 of you, so okay. Anyway, right. So these are the syllabus. So first part A, we have financial management function. Basically looks at what is the duties or responsibilities of financial management function, and then we will be looking into financial management environment. Okay, so what is the financial market is all about? Okay, what is a market? What is the role of a financial markets? What types of markets do we have and all that? So part A and part B of your syllabus will mainly tested on your multiple choice questions. Okay, you will not have a long essay type or subjective questions. It generally appears in your multiple choice questions. Then you have working capital management. This is a very, very important topic because this comes up in your section C. Okay, long questions, 20 marks. So working capital is all about how you manage, how well do you manage your working capital, which is basically how well you manage your current assets and current liabilities. Current asset consists of your inventory, trade receivables, cash. Current liabilities will mainly be overdraft and payables. So it's very, very important how you manage your working capital efficiently. A company can be profitable on paper, but if their working capital management is very poor, they will end up in a very serious liquidity position, poor liquidity positions, and can affect the company's survival. So the working capital is very important for any business. Then comes the most important topic, which is your investment appraisal. Investment appraisal are popular in section B as well as in section section C, B and C. All right. So I would say 99% you will have a question. Okay, 99% you will have a question on investment appraisal. Okay, this is something that you cannot avoid. This topic you cannot avoid. Okay, investment appraisal. So this is a huge bulk here. Investment is a huge topic. So not only you will learn to calculate NPVs, net present value, IRRs, you also need to look into tax. You also need to look into inflation, change in business risk, buying or leasing option, asset replacement policy, capital rationing. There are a lot of subtopics within the investment appraisal syllabus, part D. Okay, there are a lot of subtopics. So as I said, 99% sure to come up for your exam. Okay, there are a lot of things, so any part of it can come up. So it's very, very important that you understand that it's important that you know your investment appraisal topic in and out, right? So the next one, part E, is your business finance, another very important part. It's very often that you may have part D, investment appraisal, and business finance combined together. So business finance is all about, what is that? It's all about raising finance for an organization. When you say raising finance, normally we look at equity and debt. So raising equity and debt has an effect on companies' value, company survival. So we need to look at what is the best choice of capital. What is the best way to raise capital? Should we go for equity or should we go for debt? How will it affect the company's ratios? How will it affect the company's earnings per share, market price, dividend income, all that? Cost of capital, very, very important topic, estimating the cost of capital. So part E, there is 70 to 80% chance definitely you will have a question in your financial management paper. Okay, business finance. Then you have a business valuation. This one will appear in your section B. A, maybe just MCQ, but quite popular in section B, not in C. Okay, we will talk about what is section B, A, B, C in a short while. Okay, so business valuation. How do you value your business? What are the techniques? What are the advantages and disadvantages of each technique? Okay, business valuation. Then we move on to risk management. Risk management again will only appear in your section B. Okay. We have two types of risk management, which is your Forex, foreign exchange risk, and also your interest rate risk. Okay. The foreign exchange risk, Forex risk, is more popular than your interest rate risk. Okay, that is what most of the time will come up. Okay, Forex. So this appears in your section B. Then you have a new topic has been included, which is employability and technology skills. It is not so much, okay, it's not really a detailed syllabus. Right? It's not so much of a detailed syllabus. It's basically about how students use technology, IT, and all that to improve efficiency and to prepare reports and all that. So that's all about everybody. So it's not something which is detailed or important. Right, so that is what. So as I said earlier, before I give you a little bit summary, this is the detailed part of your syllabus. All these are available in your textbook, also in your ACCA website. Hold on, I just want to show you something. Oh yeah, it's not here. Just hold on. Here. So as you can see, your section A, right? The computer-based exam comprises 15 objective test questions with 2 marks. So that is 30 marks there. And section B is a computer-based exam comprises 3 questions each containing 5 objectives. So this is a scenario based. So they will give you a very short, simple scenario, and then they will give you 5 MCQs questions, objective test questions related to the specific scenario. So as you may have a scenario on foreign exchange question. So they will have
right.
Objective test.
So nobody's here, Jill. Can we start or what? Or shall I wait?
So among the 5 objective test questions that you have,
Yeah, we can start if you want. Start.
Very often,
Okay.
you will have about 2 or 3 calculations. Another 2 or 3 will be on theory.
So
objective
anyway, good
test
evening
question,
to
but it won't be all
everyone.
calculations.
Now we're gonna look
So
at
you will have
investment
at least 2
appraisal
or
today.
3 calculation, 2 or 3 theory. So you say, for example, which of the following is not advantage
So I started off last week.
of investment appraisal
Right, so
or NPV or something like that, for example.
There
So
are
you
2
may
ways
have,
to
you definitely will have a mix
methods.
of theory and calculation. Whereas the section C of the exam comprises
so one
2
was
20
not
marks.
discounting.
Okay. Constructed response questions. The 2 20 marks will mainly come from working capital, as I told you.
So we already talked
very
about
investment
non-discounting
appraisal
in the previous class.
and
we
business
looked
finance area of the syllabus.
at simple
Okay. So if you were to summarize,
payback period.
okay, you have, hold on,
Yeah. And the other one is
so you have a section
return
A,
on capital employed.
you have
So we're going to
50
focus more on a discounting
MCQ
method because that's the most
times
important.
2 marks. Method is 30 marks. Okay, and you will have section B. So examples, of course, you have 3 scenarios. Right, 5 discounted
MCQs.
payback period. Okay, so they'll give you 15 questions times 2 marks, so that's another 30 marks.
You
there.
have NPV.
And then you will have
You also
section
have IRR.
what do you call it? C. So what is a discounted? You will have
Sorry, what is discounting
two
methods?
questions. So,
So
discounting
20 marks.
methods is basically okay
Based on
each. So 2 questions. So that's
cash
about
flows.
40 marks profit.
So all in 100.
Okay. So this section C, you will have questions
future.
on working capital, WC.
Cash flows.
You will have, probably you may have a question on
I have to say all
investment
future
appraisal. And the other one will
relevant
be
cash
business finance. Right? So section B,
are discounted
A can be anything.
to
So B, you can have here
Present.
is your risk management,
value.
business valuation.
So you must understand when you say discounted means it's the opposite
Others.
of compounding. I discussed this.
So
in
even
last week.
working capital can
When you
appear
calculate
in your
future
A or
value,
B.
you are
Same
compounding.
thing for investment
But when
appraisal,
you're
business
calculating
finance
discounting
can appear in
value,
section A or
present
B.
value, you are.
But section C
discounting.
only
So all
focus on
future
these
relevant
3
cash flows
key
are
areas.
discounted to present.
You might have a question on working capital or investment.
So when you
appraisal
say
or
relevant
business
cash
finance. Right? Understand?
So what
Clear
is
so
a
far?
relevant cash flow?
Yes, sir.
Thank you.
So relevant cash flow
Right.
must satisfy.
You will also be given exam hall. You'll be
must
given
satisfy
a formula table.
all
So
3
you must know how to use the table
criteria.
to make your
Must
life
satisfy
easier.
all 3 criteria.
So not all formulas you are required to memorize. Some formulas.
So what are the 3 criteria?
Is given to you. So for example, you have must involve first one EOQ, economic order quantity, million or model, okay, return point spread.
Must be for
So this one, the EOQ return
Future.
point million model, this will be relevant for your working capital topics.
must vary
Working
between
capital syllabus. When you're talking about managing your cash, this return point spread is your cash management.
alternatives.
The EOQ will be your inventory management.
You must
It's relevant
satisfy
for inventory
all 3
management.
criteria. Must
Okay.
satisfy
And then you
All
have
three criteria.
capital asset pricing
So when you say
model,
must
asset
involve
beta
cash flow,
formula, okay, and
what does that
you
mean?
have a growth model.
It means non-cash items.
Okay.
Can you tell me what are the
And
non-cash
Gordon's growth,
items?
weighted average cost of capital, Fisher formula. Okay, so right. So that means from your CAPM
non-cash items,
asset
example
beta,
like
growth
what?
model, right? Gordon's growth, and also your weighted average together Fisher. This will be all relevant for your investment appraisal. It also will be relevant for your business finance.
Must be for the future.
Okay, so all these can be used for
What does that
business
mean?
finance as well as for your investment appraisal.
Past cost.
Right, and then we have purchasing power
Either.
parity theory and interest rate parity theory.
Must vary between
PPT
alternative
and IRPT and the Fisher formula. These two will be
unaffected
relevant
costs.
for your risk management.
Example like
Okay,
what?
will be relevant for your
Fixed
risk
costs
management.
are either.
Okay, got it? All right. So you will also have a present value table. All right, present value table.
So there's a very important note here.
Have you ever seen this table before in any other subject?
Yes, sir.
And
okay, good. What does
interest
this
payment.
table represent?
Dividend and interest payment.
Okay, let's say I take a figure here, 0.65 here. Let's see whether I can. What does
excluded.
Okay, what does 0.65 here represents? Can somebody tell me?
Process.
You must know. You must be able to understand. People must be able to interpret. Then only you know how to use it. Yeah. Can somebody tell me?
NPV and
Sir, that's the present
excluded.
value of 9% for 5 years, 5 periods, in other words.
Okay, let's say
dividend and interest.
I'm a small kid. How do you? I'm
So
I'm
why
a
is it
schoolboy or whatever
excluded?
it is. How do you make me understand?
Why is the
How do you,
dividend interest
when you tell me like this, I
excluded
don't
from
understand.
the
I don't
process?
understand what you mean by present value and all that. How do you make a layman? How do you make a layman understand what
It's already
0.65 here represents?
taken into account. In the
Anybody?
cost of capital. Already taken into account.
Sir, can I try?
Cost of
Yeah, of course,
capital.
can. Anybody,
So,
no problem.
It is the
When you
amount that the person
your
can
cost of
get
capital.
after 5 years, or the estimations.
okay.
So 0.65 is the amount
consists of
the
what?
person can
Your
get
cost
after
of
5
capital,
years.
which
Is that
you
what
will
you're
learn
trying to say?
later.
Yes, sir.
Sorry,
Consists of two
unfortunately,
things. Cost of
no.
equity,
Anybody else?
which is your
We all know how we have used this table before,
cost of
right? But
debt.
see, when I ask you to
Which
interpret,
is
you
your
can't actually tell me how
interest.
this table works.
So it's already
What does
part
this
of
table
your cost of
represent?
capital. So that is why you do not what's that? Include in your NPV or IRR calculation. Okay.
What do you think?
So now let's look at NPV, net present value.
All right.
Again, as I said, all future.
You should be saying it the other way around. What you get
are discounted
in year 5
at
is
cost
not
of
0.65.
The whole amount.
What you
sir.
capital.
Sorry. I mean the whole amount, which the amount in the fifth period, that will be the amount that will be received from the beginning.
Total of all. What does 0.65 means here? Present value.
Yes, very simple.
Is your net So now, which is considered as year 0, this is year 5. If you invest cost of capital 0.65 now,
It's also
at
what?
9%
It
per
also
annum,
refers to what?
you will
Required
get $1 rate of.
It's not 0.65 in
How
year
much
5.
return do they?
The
One.
0.65 represents what?
Return.
Present. That's what it says, present value. So present, if you put 0.65, in future,
So
you will
decision
get
making.
$1 in 5 years' time. If the money is compounded, the interest is calculated, the interest rate
If
is
NPV
9%, compounded on an annual basis.
Positive.
What do you mean by compounded on
NPV
an annual
can be what?
basis?
Negative. If NPV positive, what do you do?
What do you mean compounded on an
Except
annual
the-
basis?
Project. Your returns are more than
Do you know what's a
cost
compounding?
of capital, COC. If it is negative,
So, let's say
obviously
now-
you will what?
0.65.
Reject the
Year 1,
project.
9%. Let's do a very simple calculation because this is all basic.
So
eh?
if your
Basic
returns
will
are more
include-
than cost of capital,
So how much is this? This is about
It will
0.0585,
maximize-
something like that. So if you add up shareholders' wealth, if you add up this,
right?
you will get
NPV
0.7085.
is an absolute
And then in year 2,
measure based on
another 9%.
dollars.
Okay, off.
So maximize shareholders' wealth. How?
Right? 7085. It's about 0.
So NPV positive means what?
0.09. Yeah.
Extra return.
0.0637 something 65.
That's it.
So if you just
So
keep
extra
doing
return,
this,
what is that?
then
Increase
in year 5,
company's
you
what?
will have how much?
Value,
$1.
share price go up.
So that is what the
Shareholders
table
will enjoy
represents.
what?
Okay.
What
So
do you think
if
the
you want to
shareholders will
get
enjoy?
$1 in year 5, and the interest rate is 9%, okay, you need to invest 0.65 now.
Capital?
0.65 now.
Gain.
Okay.
Extra return can
Got it?
increase what?
You all understand?
Dividend.
Yes, sir.
Okay, good.
Income.
Now, there is also another table. That's why I said the present value.
So this
of
is
$1,
how you
huh?
maximize
So this is
the
the
shareholders'
formula.
wealth.
1 plus R to the power
Right,
of
when the
negative.
NPV is positive,
There's
it's
also
beneficial
another
to the
table
company.
which is given here is the annuity
which
table.
eventually
Okay,
becomes
given the
beneficial
formula.
to the
So what does the
shareholders.
annuity here represents?
So that is, if it's positive, you accept. If it's negative, you reject. Now,
So let's say we talk
what are
about
the
4.1
items?
What does 4.1 here
what are
represents?
the, what do you call it, relevant cash flows?
What does 4.1 here? 7%. Okay, so I want you to look at here this present value table. If you take your calculator, if you take 0.93 plus 93 plus 0.873, you should be
hold on, I wouldn't say relevant
getting,
cash flows.
okay, annuity 7%, year 2 how much? 1.808. So if you add up the present value table, you will be getting the annuity table. So basically the annuity table is
What are
the
the criteria
cumulative
to calculate
of present value table.
NPV?
Alright, so let's say just do one more. Can you
So
add
of
up
course,
all this? 093, 0873, 0816,
What's that?
0763, 0173. Can you
Relevant.
add up everything? How
Cash
much does this
flows.
give you?
Number 2, inflation.
How much does it give you? Important area.
4.1.
Calculation. Inflation. It should give you 4.1.
So what about inflation
which is
here?
7% year.
So when you talk about
annuity.
cash flows, can be in real terms, can be in
annuity. Okay, so these are the two tables. All right.
items.
So where's
nominal
your schedule?
terms.
Yeah. Let's look at your schedule here.
Real terms.
So today we're gonna look into
real
financial
term
management function and environment. Right. Then you will have after 2 weeks on the 4th of December. You will be having a topic on investment appraisal. So you need to do a lot of work.
Inflation.
I only have 2 hours to talk about a very important topic. So make sure you revise, go through, or if you have any questions, you have to ask me. Don't wait for me to give you a webinar, then you go and read up. If you do that,
so
you're
if
not
you
gonna
are
understand anything.
excluding inflation,
so it's easier, faster, more efficient if you do all the reading on your own first. Then you listen to my webinar. Okay. Then you will have a better understanding. You can understand much more faster, and you can also at the same time
discount rate
can ask me questions related to the anything that you don't understand on your investment.
Use real rate
part. Then we have source of finance. That's another one.
If you are using
then
money
have this
then you
cost
must
of
use
and capital structure. And then we have a webinar. Again, this is also very important.
Nominal rate.
Right, your session 4.
So what?
Source of finance, or cost of capital structure is very important. Business valuation, and then the risk,
NPV,
management, forex, and risk management,
nominal
rate. And then working capital. If you look at under ACCA syllabus guideline, working capital is covered first. It's part of your is under part C, but in the relationship study plan here, working capital will be covered at the end of the semester, before your mock exam. This will be our last topic, working capital. The reason why we why we are doing working capital later is because you will have a better understanding after doing the sources of finance.
Nominal rate, or sometimes they also call money rate.
Okay, right. So the first thing here is your financial management function. Okay. 1 plus money rate. So this financial management basically have
1 plus real rate times 1 plus
3 key
inflation
decisions.
So example, I'll give you example 1,
known as,
let's say M is 12%.
Triangle decision.
Not M. Let's say your R, real rate is
triangle?
5%. Your I
is the investment
3%.
decision.
So what is your
One
M?
is the dividend policy. And the other one is the,
what is your M?
Financing. Why is it called a triangle decision? Because,
so your M will be what? 1 plus M equals to 1
decision
plus R,
or change
5%
in one area
times 1 plus I 3%
will affect.
So what is your M here?
Will have effect on the other 2 areas. You understand or not? Example. So your M will be, you decided to have a high dividend payout.
8 point.
High dividend payout. So when you have a high dividend payout, you will have what? Very low. What is that?
Example 2.
Cash. Do you agree? you have a
If
very
your
low
M
internal
is
cash.
12%,
This is
your
outflow.
I
You have
is,
a
let's
high
say,
dividend
5%.
payout. So you have a
So what is your
low
R?
internal cash. So what happens?
So M1
You will
plus
have what?
12% bracket 1 plus
Insufficient.
R, don't know, 1 plus 5%.
Funds for what? For, so your R here will be investment.
How much?
So what happens?
6.67%.
May have to what? Depend on what? External.
So you should be using money
Finance.
rate if you are
Or
including inflation.
new-
You should be using real rate if you are excluding
investment.
inflation.
So if a company pays high
Okay, so
amount
that is
of
something very
dividend,
important.
that means they are not keeping a lot of reserves. They are not keeping a lot of money. So if that happens, then they may not have a lot of internal funds to invest. So if they have a very good projects, they want to build a factory, they want to expand their business or production facilities or whatever it is, they have to source the finance from external parties. Maybe get money from new shareholders, issue shares, a right issue, or raise bonds, or take a bank loan, or whatever it is. They have to depend.
Right, so that is on inflation part.
Okay? So it's very much
The next part here
same
is
for
number 3
individuals.
would
You
be
get
your
a salary. If you spend if you spend
what
most
you
of
call
your
working
salary
capital.
for shopping and buying things and all that, definitely you won't have
another
money
area that you
to
should
invest.
also
You won't
be
have money to
careful
buy
here
a
is the
house.
working capital.
You may not have sufficient money to buy a car. So what do you have to do? You have to depend on
normally
a bank
what
loan
happens,
to buy a car. So at the same time, if a company
any
does
new
not pay a high
investment or
amount of
project,
dividend, likes to keep all the money by themselves, they make profits, they like to keep. Why? So when they have a high amount of reserves, they can use their internal reserves to invest in other new projects.
additional
So the value of the company will go up. So they no need to
investment
depend
in
on what?
working
Shareholders'
capital,
money a
that you
lot.
see. Okay.
They no need to depend on debt finance.
So what is this working
borrowings, or
capital?
whatever it is. They have a high amount of, what is that? Internal funds.
For day-to-day transaction.
So
You need
if
money
you
for your
if you are
day-to-day
interested in investment, you want to invest here, you want to invest there, then you have to ask yourself,
so
can you afford to pay a high amount of dividend or not?
your investment
Cannot. You have to conserve your dividend payout.
in working
You have
capital.
you have to conserve your cash. So minimize your dividend
Year
payout
zero,
so that you can have a high amount of
Will
internal
be outflow.
generated cash. Otherwise, you may have to depend on external finance. Depending
year end.
on external finance has a lot of implications. If you're going to get a new shareholders,
That means at the end
existing
of
shareholders may not be happy. If you're going to get money,
project,
if you want to ask money from the
working
existing
capital,
shareholders, again, they may not be so happy.
maybe what's that?
If you want to take a bank loan,
Recovered.
it's risky. What happens if you
So I
cannot
have
pay?
to stress here.
You
I
can
use
see
the word
what happened during
maybe
pandemic.
recovered.
A lot of
So that
companies with a
is
high amount of debt
consider what?
have to close business, cannot afford,
Inflow.
cannot maintain the
So it's
interest
very
payment.
important you read the
So taking
question
too much debt is also a very risky business.
carefully.
So as you can see, there are few factors you need to consider. Okay, I mean these are the 3 important factors, decision making, that you need to consider, right? When you want
Then
to
you may
talk
have
about financial management decision. That's why they call it what do you call
additional
triangle, right? Decision making.
investment or
Follow?
recovery
Done?
during the what's that project period.
Yes,
There will be
sir.
additional investment
Okay,
for
good.
recovery. So what are financial objectives? So what do you mean by additional investment? Financial
That means-
objective.
Right? Consider outflow.
So the primary
In year 1,
Objectives
2,
are
or
what?
etc.
maximize Recovery
Shareholders'
is considered inflow. Yes, maximize shareholders' wealth. Right. So maybe example
also must
in
achieve
year 3 or growth or something like that. Recovery inflow.
In
Okay.
EPS, earning per
when activity
share.
you can also talk about profit reduces
Maximization.
so reduces. So let me give you an example. So let's say year 1, 2, 3, 4.
But of course, the most important
so
one
your sales
will be maximize shareholders.
in millions.
So how do you maximize shareholders?
5 million, 8 million.
How? Two ways.
6 million.
What is that? If you are a shareholder of a
And
company,
probably drop to
a public listed company, how do you think it will increase your wealth? Think from the shareholders' point of view.
Working
If you're a
capital.
shareholders.
Let's say maintained.
What do you need? What will make you
10%
rich?
of
dividends.
sales.
Yes, one is the dividend income. What's the other
At
one?
the beginning of
Capital
the
gains.
Yes, and
year. For the years.
capital gain. So when you say capital gain is the increase in
Just give me a minute. Just
share
give me about
price.
2 minutes. Jill, just give me a minute. I need to solve
ways.
something here.
So this can be achieved by investing in positive NPV projects. Can be achieved by investing in positive NPV project. Okay, right. Ratios. This is very, very important. Ratios. You don't know these basic ratios, I suggest don't do this paper. These ratios must be in your fingertips, like how you know your ABCD. First of all, very simple ratio will be your dividend per share. We call it DPS. How you calculate dividend per share? Of course, very simple. Total dividend paid divided by what? Total number of what? Ordinary shares.
Ordinary.
Yeah, correct. Then you have earnings per share, EPS. This is very, very popular. This is one of the most popular ratios. EPS, earning per share. How you calculate? It is PAT, profit after tax, minus what?
Preference shares.
Yes, not preference shares, preference dividend. Okay, preference excuse me, preference dividend divided by number of
ordinary shares as well.
Yes, number of ordinary shares. Correct. Then we have dividend yield, DY. Is basically DPS divided by market price per share times 100% yield. Yield means, what is that? Return. Dividend return. Yield. How many percent do you generate? So you paid for a
market price and how much. So what price? Right. Opening share price. When the price that you paid at the beginning of the year or what before you got the dividend yield. Then you have dividend cover, we call it DC, also very, very important, dividend cover. So profit after tax divided by minus preference dividend divided by total dividend. Or you can also take EPS divided by DPS, dividend cover. How many times? So here your answer will be in, what's that? In times.
Okay, sorry for that. All right, let's
1
continue.
times or 3 times or 4 times or what?
So let's say your sales 586.
Dividend cover. These are all very,
working
very important
maintain
ratios.
10% sales at the beginning of the year.
Then another
years
very important ratios will be your price
for your, if you look at your calendar
earnings
here,
ratios. We call it
right? So this
PE
is
ratio,
year 0
price
now.
earnings ratio.
So this is 1.
This one
End
is
of year
market
1,
price
year 2,
divided by
year 3,
EPS.
year 4.
Also answer will
So your
be
sales
in
is
time.
5 million, 8 million, 6 million, 4 million.
Right?
So this is the first
one
year
will
of
be
the
your
business. So when you
closing
say
price.
working capital, that percent should be 500,000, 800,000.
Then you may also have earnings
600,000 and
yield.
400.
That's not was a dividend yield.
So
This
what
is
you do
earnings
here
yield.
is
This one is EPS
in year 0,
divided by market price.
you will invest
Times
working
earnings.
capital
So
investment.
it's or what is that? 1 over
Working capital
PE
investment will be how much?
because it's the inverse of PE ratio.
500. For year 2, sorry, in year 1.
0.
So this is for,
So based on
What
the
is that?
market price, what is the
for
percentage?
year 1. Sale.
Is the earnings.
In year 2, what?
Which is the
Sorry, in
earnings
year
in
1,
terms of percentage.
you
This
need
earnings yield.
800 for the second year sales. You need a working capital of 800,000 for the second year sale. You already invested 500. So you just Then have you to
also
add
have
on how much?
ROCE, return on capital
Another
employed,
300.
which is what?
So
Profit
you can
before
see you already have
interest
500 in year 0.
tax.
So you have to just add
PBIT.
300. So if you add up both, will come back to
Sometimes
what?
it is just called operating
800. So what happens in year 2?
profit divided by capital employed.
So you will invest in year 0. You will invest in year 1 300. How much would you
percentage?
need for year 3 sales? You need 600,000 working capital, but you already invested 500 and 300, so you already have 800,000.
Profit
But you only
before
need
interest and tax.
600,000,
or operating profit
so you
divided
just
by
have to-
capital employed times 100%. Okay, so these are the important
600.
ratios you must know.
So what you have to do
Right,
is,
so if you
already
will
have
come across
800.
all these ratios a lot
So
later
what you
on
do,
in
you
other
will
areas.
recover.
So you must know how to
200,000
calculate, you
in
must
year
know how
2.
to interpret. Right, sometimes some information is given, certain information is not given, so you have to use all these basic
So
ratios
this is outflow.
to get other information.
This is outflow.
See?
This
If you
is
want to
what?
interpret your ratios, don't just look at
Recovery.
the figure, look at how the ratio is being, what is that, calculated. Okay. Okay.
So you can
That's
see
very
plus
good.
this, now you will come back to what? 600. You already invested 800. You recover back 200, you still have 600. So what happens in year 3? Now you need 400. So what happens now? You will recover back.
Okay, another thing that is very relevant for your function, financial management function.
So this is again recovery. Because if you add up, you will come back to in year 4,
agency theory.
What is that? You will recover the balance.
Sorry, there's one more ratio I forgot. Yeah. You
And
may
this is
also
year
come
4.
across total
You recover
shareholders
all working capital and what? End of project.
Total shareholders return, if it is in percentage, is your basically dividend income plus capital gain divided by.
So this is
opening,
what we call additional investment or recovery during the project life. Sometimes you need more money for your working capital or less money for your
dividend income.
So this can go up.
Capital gain
Down.
in opening. Share
Or
price.
you can also have
So I give you a
another
very
example,
simple
working
example.
capital investment.
Year 0, year 1
is maintained.
Market price per share was $5, went up to 5.6. So for year at level, dividend paid was 25 cents.
Sufficient to.
So what is TSR? Total shareholders return. TSR. Total shareholders return will be what? 25 cents.
So example,
plus what?
I'll give you a very simple example.
What's your dividend income? Sorry,
So
dividend income is 25 cents. What's your capital gain?
2, 3, let's say.
60.
So working capital
cents
you reinvested
divided by
500,000.
which share price? $5
So
or
there is
560?
Inflation. 5%, 5%,
Yeah,
5%.
$5. So you don't put $5.
So how much do you
make
have
silly
to
mistakes.
maintain if there's a 5% inflation?
Which is $5.
So
because
you
everything
just
is
have
in
to
cents.
add on how much?
I've seen a lot of students, they take 25 plus 60, then they
Working
divide by
capital
5.
in year
Finish,
1.
gone.
How do I get
Mistake.
25,000?
If you want to put dollar, make sure
500,000
everything
times
is in dollar. Dollar means it's dollar 0.25, this dollar 0.6.
5%. Just have to add
divided
on.
by $5. Okay, correct.
How much is this?
If you want to take cents, then make sure everything is converted into cents.
How much you have to add
So how
for
many
your
percent is
working
this?
capital? So if you look at it,
60
500
divided by 500
times
about what?
1.05 to the power of 2.
percent per annum.
Why 2?
So
Because 2
shareholders
years
return,
inflation.
total shareholders return.
So 500, 5% increase every year. So you need to invest 551,250.
Okay.
So you already invested.
So the other part of financial
500
management
in year
function
0.
is the
You already invested 25,000 in year
agency theory. So what is
1? So in other words is how much?
directors
26250.
appointed by whom?
This is the
Appointed by shareholders.
So you just have to add 26250 act in year 2 to cover the inflation. Because
As
when
an
the
agent.
inflation is when there is inflation, you need more and more money for your day-to-day operations.
On their
You
behalf.
need more and more money for your operations.
Appointed by shareholders, act as an agent on their behalf. For what? For
Okay, that
making
is your working capital.
decisions.
Next one, and what is your taxation and
maximizing
capital allowance.
shareholders' wealth.
This is very, very important for your investment proposal.
Somebody's volume is on. Yeah, directors appointed by shareholder. So when you say tax, what does that mean? Taxation. If you have for making decisions and maximizing additional profit, shareholders' wealth. Pay, right. But there is a problem here. Tax. What is the problem? Losses, but can claim what? There is tax relief or tax rebate lah, whichever you call it. Problem. Okay. What problem? If you make profit, you have to pay tax. The agent, which is the director, what's that? Paid may not act same year. Example, in the year 1 profit, best interest of whom?
Of the shareholder.
Yes, best interest of the shareholders paid in year 1. Or paid in what? Areas. Example, year 1 profit may not act in the best interest of shareholders in year 2. So solution, tax paid in year 2. How can we solve this? So what happens? So because the director is supposed to act 5-year project on behalf of the shareholders will be what? But sometimes you know that evaluated. I'm sure you have come across some companies in Philippines or in your home country in Vietnam, whatever it is. Years. Sometimes these directors just do not make have one in the best interest of the company or additional year. They will tend to focus on self-interest, self-gain. Solution is what? You need to have what? A good reward delay scheme. 1 year delay. Yes or no? So remuneration method. Example like what? Share option. Share option is good. When you give them a share option, they will need to improve. Then you also need to have what?
On the taxation.
Implement corporate governance codes.
Capital allowances.
You need to have some corporate governance codes. AGM, non-executive,
what?
Corporate governance. Example like what?
Depreciation.
We call it NED. NEDs means non-executive directors, executive directors, remuneration expenses. Committee. So it's actually a non-cash item. But these are the things. AGMs. What's that? Reduces what? Tax payment. Separation because it's tax allowable expenses. So chairman and calculate what? Executive. What do you call officer? Tax relief. Or CEO. Chairman and CEO. Capital allowance. CEO. Chief Executive Officer. So it must be 2 different people. So the chairman and CEO must be 2 different people. Otherwise, they can easily manipulate and make decisions. Capital allowances. Is it? So these are the things. As 25%. These corporate governance codes are very, very important, very strict. If the company is public listed. Balance method. Okay, the company is public listed. But what is your financial 4 years objective for not scrap value, not for profit organization? Financial objective for not-for-profit organization. 200,000 because this not-for-profit organization, example like what? Public sector
tax 30%,
charity, NGOs,
payable in
so all these they have what? No shareholders. So
areas.
no maximizing what?
So how does it
wealth.
work?
So what is
So
your
we have
financial
the
objective
cost.
then?
So let's say I put it in thousands.
So
2 million.
you can use the what?
Year 1 capital
Value for
allowances 25%,
VFM.
which is how much? 25%
Value
will
for
be
money. That will be the objective.
5.
So value for money
100.
is,
So your written down
The
value
three E's.
is 15.
economy,
Year 2 capital allowances
Efficiency.
25%, which is
effectiveness.
3.
Economy means
7.5. Your written down
do
value
you
is
Achieve what?
1125.
you have the lowest input cost.
So year 3 capital
Efficiency
allowances
means
25%.
Your output is more than your
2.8.
input.
1, let's say.
Effective means
I round it up. So
Achieve
this will
the
give you 8.
objective.
4.4. Now what
Satisfy.
happens in the final year? You no need to
Stakeholders.
calculate. So there is a disposal for 200. So your written down value is 844, but your disposal 200.
Correct?
So there is 644. Is considered as a what? This is considered as a loss. So this is what you call year 4 balancing
Okay, so basically that is the function.
allowances.
So the important
This
one
is a
that you
loss.
must know,
The value is 844.
you
but
must
sold it for 200,
know
so it's
is
a
your
loss.
what?
Okay.
What
so
is the
once you have
important
done
ones
your
when it comes to financial management
capital
function,
allowances, the next one here is
Right.
your
The
tax
triangle decision.
30%
which is the investment
relief.
dividend policy.
Tax
There's a
relief, lah.
topic later on you will study
So
just
this will
about
be
the dividend
150
policy
in
and
thousands.
financing. As I told you, part
So
E
375,
of your syllabus
30%,
is
131.
financing. Right, so we will talk about
281,
it, and D is your investment. So
30%
all these 3
is
decisions
84.
we will talk about it in very
And
detail.
here balancing
later part.
allowances. So because
It's a
it is
separate topic by
a
itself.
loss,
That's why it's very
allowances.
important. Okay.
can claim
Then the other important
Tax.
part in your financial management
Tax relief.
functions will be all your key ratios.
you can claim 190.
EPS, dividend yield, earning per share, PE ratio,
So the question here is the
dividend
timing.
cover, right? Shareholder total
So
shareholder
because
return,
it is
this-
paid
all these
in
ratios,
areas, so your
you
timing will
must
be
know,
what?
You must know.
This is year 1. But
Right.
because of areas,
Next one
so this will fall
is
in year
your
2.
what's that?
Delayed.
financial
Okay.
uh,
Delayed.
management.
So this will fall in what? Year 3. This will fall in year
Environment.
4. And this is 4-year project. So
Okay.
this will fall
So
in year.
we will just take a quick 10 minutes
So all
break.
these are tax relief.
We'll come back.
That means what?
So normally I'll give a short break, toilet break.
When you
or
say
whatever
tax
it is,
relief means
so
what?
we can come back and continue
And
on
this
it.
is what? Inflow. Reduces the tax payment.
Of course, if you have any questions, you can ask me. No problem.
So when you do your NPV, in year 2, you will put 150. In year 3, you will put 131. Year 4 is 84. And year 5 will be 193. Balancing. There's a tax relief for each year from due to capital allowances. So if you notice here that if profit, then what do you have? You will have balancing charge, BC, balancing charge. So I have to what? Have to pay, what's that? More tax. You have to pay tax. Let's say the written down value is just now is 844, but you sold it for 900. So you made a profit of 56,000. So you have to pay tax on that, 30%, whatever the tax. So that is balancing charge. They charge you because you made a profit on disposal. Okay. All right. That is on your, what's that? Taxation. All right. So now the NPV format, very, very important. So of course you must have a heading. Example, NPV of a project, let's say XYZ. Okay, example. Then you'll have year 0, 1, 2, 3, 4, 5. If tax is delayed, let's say. Then you may want to put it in dollars or maybe in thousands, okay, or maybe in millions, okay, depending on the question. Sometimes, so check whether it's a dollar in million or dollars, check what is that. The next thing you have is all your P&L items, profit and loss account, sales, all your costs. What costs? All these will be your operating costs. So of course year 0 nothing. Also in years for operating costs. So you will have a dollar here, dollar here. This will be in bracket. Right, let me put some figures here. Dollar. Here nothing because this is for tax 4-year project. So you will have expenses. You may also have opportunity cost because there could be some relevant cash flow opportunity costs. Then you have, what is that? Operating costs will be like what? Material, labor, overhead, all whatever, salary, admin costs, whatever is relevant cost. Then you have, what is that? Cash flow before tax. Then you have tax. This tax will be, I assume it is delayed, let's say. So nothing here, you will have here. So this tax will fall in year 2. This will fall in year 3. Year 3 goes to year 4. And then year 4 will go to year 5. All right. Then what do you have? Then comes the tax relief on capital allowances. Okay. So in my example, let's say just now, where is it? Here. So let's say 150, 131. So let's say example, 150, 131, 84. What was it just now? 193. Example. It's an inflow. Then comes your working capital. Okay. So working capital. Example, like I take the earlier example I gave you, let's say, where is it? Yeah, here. 500, 300, 200, 200, 400. Okay, so what happens here is
I will invest 500, invest 300, then you recover back 200, 200 and 400. Then you have investment. Then you may have scrap value or disposal value. When? At the end of the project. Then finally you will have your net cash flow. You'll have dollar here, probably dollar here. Then you have, what's that? Discount rate, which is your cost of capital, COC. Let's say, example, 10%. So 0.909, 826, 751, 683, 621. This one you take from your present value table. Then you have present value. Then you have NPV in thousands. So here will be probably negative, positive, 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 probably positive, here also positive. So if it is positive, what do you do? Accept. If it is negative, you will reject. This is the format of your NPV. You cannot run away from this format. You have to do this way. So whenever you do your NPV, make sure you follow exactly this format so that you don't miss out any figure. Sales, put down, first thing is the sales, then minus all your operating costs. Okay. Then we go to opportunity cost. If there is any opportunity, then you have cash flow before tax, then tax relief on capital allowances, then working capital, investment, right? Then if there's any scrap value, you put down your scrap value. Then you have a net cash flow, discount rate. So discount rate, as you know, there's two discount rate. You can use the real rate or money rate. You have to check real or nominal. You have to check. If you have included inflation, then you have to take nominal rate. If you have excluded inflation, then you take the real rate. So it all depends on the question. Okay, it all depends on the question. Okay, got it? Right, so that is on your NPV. The next one is your IRR method. What is IRR method? Internal rate of return. So what do? You calculate the discount rate, IRR, when NPV will be 0. Will be 0. So 0 means, that means what? Cost equals to PV of inflow. You can say something like what? Break even. Okay, something like break even. So decision making. If your IRR is more than cost of capital, you will accept. If it is less, you will reject. So let's say, example, let's say if your IRR is 18%, cost of capital
All right.
is 12%.
So we'll come back.
So this
We'll
is
continue. Can you hear me?
required
Is it okay?
return. This is the
Yes, good. All right.
maximum return.
So we look at financial management environment.
So that means what?
So
NPV
when you say economic
negative.
environment, we have macro
NPV will be negative if,
and we have
discount rate
micro
is more
economic.
than what?
So
18%.
micro is just about demand and supply. Okay. So we're going to look at macro economics.
So that's a maximum.
First.
So it can give you a positive NPV up to 18%. So 10%, 12%, 13%, 14% is all positive.
So macroeconomic
gives you up to 80%. If you want to go more than 18%, cannot. It will be a negative NPV.
Every country
so
will
you only
have
want 12%. That means what? So at 12%,
so
NPV is what?
In relation to macroeconomics, what
so
are
you will
the
accept
key objective?
So if your IRR is more
any
than cost of capital, you will accept.
Country. The key
So
objective
how to
of
estimate
any country is to
how to calculate IRR?
achieve
Using what?
economic growth,
Using
achieve
interpolation
price stability
technique. What is interpolation technique?
Achieved what do you
So
call
based on what? Two
low
NPVs at different discount
employment
rate, preferably.
Okay, and
Preferably what?
balanced,
Preferably one positive,
balance
one
of
negative what? NPV. So example. Okay. So let's say at 10%.
So basically, these are the main objectives of any organization, any country, to have
at 18%
economic growth.
NPV
When you say
negative
economic growth, means you are increasing
$3,000.
purchasing
So
power.
IRR must be
Price
between
stability, basically you look at
What's
what?
that?
Control
10 to
inflation. Low
18%.
unemployment means what?
Basically,
Easy to get a
NPV,
job.
0.
Balanced balance of payment will be your
So your IRR
10%.
using interpolation will be what? R1 plus
have a balanced
NPV1
balance of imports and
NPV1
exports.
minus NPV.
So the question here is
R2 minus R1.
so these are
So
achieved.
if you look at your R1 is 10%, let's say. NPV at 10% was
Through
5,000.
Key policies,
5,000 minus
economic policies,
what's that? Negative 3,000.
such as monetary policy,
So what do we get?
fiscal policy, and you can also have this government intervention or
What do we get here?
regulations.
So we will get
Exchange policy. You can also have
5,000
exchange policy.
divided by 8,000 times 8 is about 15%.
Okay, and I'll just put here government intervention.
That means at 15%, NPV will be pension and regulations. So that is your IRR. So this is popular. So please read up on the advantages and disadvantages of NPV IRR. Okay, we will take a break. We'll come back. We look at other investment decisions, such as so let's talk about monetary policy. So what is monetary policy is all about and all that. Okay, we'll take a break, 10 minutes break. We'll come back. We'll continue on this. All right. So this is focus on two things. Focus on controlling. What's that? Money supply and increasing or decreasing what? Interest rate. How? How does it work? If inflation is high, so what happens? Reduce. If your inflation is very high, you will increase interest rate. Inflation high means a high price, high demand. So increase the interest rate, reduce money supply. So when you increase interest rate, you will have less money in your hand, less shopping. So when you have less shopping, less demand for goods and services, so your price will drop. Inflation means what? Prices are going up. Do you think inflation is good or not? Or do you think you must have inflation? Or there should not be any inflation? What do you think? Do you think there must be inflation or no inflation? Or inflation is okay? What do you think? Do you think inflation is necessary?
Yes, sir.
Why you say inflation is necessary? On what grounds? Yeah, sorry, you're saying?
Sir, I think inflation is necessary because the money is fluctuating. It is not in a constant. It is not constant.
Money is not constant. I don't understand. Okay? First of all, you know what's inflation, right? Prices for goods and services are going up. So today you buy a cup of coffee for $1. After 1 year, the cup of coffee is $1.20. So there's 20% inflation. So my question here is inflation good, or is it necessary, or it should be avoided? And you say inflation is good. Because do you think your demand should be more than the supply or should be equal? Do you think the demand should be more than the supply or should be equal? Or lesser than the supply?
Sir,
what do you think?
For me, sir, I think demand should be higher than supply so that you can...
Yes, demand, yes, correct. Demand should always be
higher than the supply,
but not too much. If you have very high demand, that's where the inflation starts. That's when the prices will go up. So demand must always be slightly more than supply. Then only production, then only companies, then only people will have work. As you keep producing, people are buying. You keep producing, people are buying. So that is good for the economy. So there's always a need to produce. Why there is always a need to produce? Because there's always a demand for the product. So as long as the demand is more than supply, companies will run, employees will have job, yes or no? Economy will keep growing, keep moving on. So that is why. But what happens sometimes, your demand is more than your supply, too much, that's when you have high inflation. So to reduce the level of demand is to reduce the level of money supply by increasing the interest rate. So when you increase the interest rate, borrowing becomes difficult. Yes or no? People will be more interested in investing than spending the money. So this is if slow economic growth. Do you think there's a slow economic growth everywhere in the world? Currently, do you think globally our economy has been affected?
Yes, sir.
Yes or no? Yes. So what do you think the majority of the countries have done? What do you think the majority of the countries have done to stimulate if a slow economic growth? To stimulate, what do? You have to what? You have to reduce the interest rate. Right? What is your base rate now in Philippines? Your bank's base rate, your central bank, I assume it's called Philippine Central Bank. Do you have a central bank? The main bank for the government?
Yeah, yes, sir, we have Bangko Sentral ng Pilipinas.
Sorry,
Bangko Sentral ng Pilipinas.
Okay. Bank of Philippines lah, basically, is it?
Yes, sir.
Okay, so what is the base rate now? What is the base rate? Do you know what's the base rate? Because lending or deposit, there's a base rate to begin with. The base rate is the monetary policy, which is set by the central bank.
The interest rate is at 2% right now, I think.
50 now, 15.
Oh.
Are you sure?
No, sir, at 2%. The Philippine interest rate or the bank's interest rate right now is at 2%.
2%?
Yes, sir.
Yes. In Malaysia
yes,
also
it's
is around that. Yeah, in Malaysia also it's around 1.5. I can't remember. So you can see is it considered very low in Philippines? Is it low? Normally, is it low as 2%?
No, sir.
No, isn't it? It's not supposed to be as low as like this. But why is it low? Because we had a very bad pandemic in the last 2 years. I mean, 2020 and 2021. 21 is going to finish. We still have not fully recovered. So majority of the countries have reduced the base rate. Some even went to 0%. The reason why, because they want people to have more money in their hand to stimulate back the economy. Yes or no? Right? To create demand and all that, to make borrowing very cheap. Right? So reduce interest rate. So borrowing becomes cheap. You will have more money in your hand. Okay. So that is your monetary policy. As the fiscal policy, concerned with what? Two things here. Taxation and government spending. High tax and low government spending will what? Will what? Will reduce what? Growth. Will reduce economic growth. Because of low, what's that? Demand. If you're going to charge a very high tax, people are going to have less money in their hand for shopping. If government is not spending, you're not creating demand for goods and services. That is why sometimes government need to do all kind of projects. They have to keep doing project after project after project. They collect money from workers in the form of tax.
Okay, so let's look at some of the
excise duties or whatever collection they have. The government receive. The government have
investment
to spend back.
Appraisal.
They have to spend to create demand for goods and services, to create job opportunities.
So one of it is
so that people can keep working and keep contributing for tax.
Decision. So this is
that is what fiscal policy is all about. It's all about taxation and government spending.
Decision. Okay. Not investment decision.
Then you have the others, as I
financing
said earlier,
decision, not investment decision.
Exchange policy.
So
if home
when you say lease or buy decision, so we are looking at which is cheaper.
Which is better? If home currency depreciate, import is better or export is better?
Is what? Cheaper. So when you say which option cheaper means, are we going to buy or
import or export?
Lease.
Home currency. So export, yes, export very, very important. Will benefit in lease or buy. Hold on. If home in lease or buy decision, currency appreciate. In lease or buy decision, import. Okay. Will benefit. Cash flows are discounted. So what you have here is using either one will not after tax achieve what? Cost of balanced borrowing, balance of payment, after tax cost of borrowing. What do you think Philippines would prefer? Do you think Philippines would prefer to import or export? One minus.
They prefer, sir, to import.
Not.
I think.
Philippines prefer to import. Using what?
Yes,
are you sure?
I am not sure.
Do you think Philippines government prefer to import? That means you're buying goods from outside?
Yes, sir. I think that's
what Philippines want?
So example, let's say, but it's what the country is doing right now.
Bank interest rate. No. What I'm saying is 10%. Generally, I'm not asking specifically. Tax rate. I'm not. Okay, maybe generally.
30%.
Every country prefer to import or export after tax. Cost
Export,
of borrowing.
Export, sir.
Yes. Export. Malaysia likes to export.
Will be 10%.
Thailand likes to export.
1 minus 0.3.
Philippines likes to
which
export.
will be
Japan likes to export. US export. China export. Everybody wants to export. If everybody wants to export, then who's going to import? So that is where you will have what? Dealings, bilateral dealings. Like for example, Malaysia buy rice from Thailand. Thailand buys rubber from Malaysia. Okay? Or we sell rubber to Philippines. Philippines sells sugar to Malaysia, for example. So there is imports and exports. So this is how we balance it.
That's for what?
If your
discount?
If your export is more than import, you have a surplus. So what are the relevant cash flow of cash? Surplus, they call it. If it is the other way around, then it's considered deficit. Every government wants to achieve surplus, but that is
Leasing options.
difficult. You cannot just export without import.
So for leasing
nobody
options
wants to do
will be
business.
what?
Very difficult to do business.
Lease
As I said,
rental
all
payment.
the countries want to export. Nobody wants to import. Then how to do business?
So can be.
So that is why it's important that you need to have a balance. So currency exchange plays an important part. If your currency fluctuates a lot, nobody wants to do business with with your country because your currency is not stable. Every country wants to have a stable currency, not appreciating too much, not depreciating too much.
First cash flow.
Let's say simple. You don't need to appreciate, depreciate. Just have a stable currency is good enough.
Zero.
Here, then people will like to use your currency because it's stable, easy to predict the exchange rate. You will not have unexpected gains or unexpected losses on exchange rates. So government may have this kind of thing.
So that's a lease rental payment. So you have to be careful with that.
So government may intervene.
The other one,
sometimes government will interfere.
Tax relief.
Try to protect domestic market. Have import duties. High tax on foreign goods.
Tax relief on lease payment.
In Malaysia,
because
the tax on foreign cars
the lease
is so
payment
high,
is a what?
More than 100%.
It's a tax.
So if you buy a car for 50,000, the tax is 50,000. The car price becomes more than 100,000.
Expenses
in Malaysia.
No, it's a tax.
But local made cars is cheaper.
Expenses.
There's not much tax
for
there.
buying option.
The reason so that local cars are cheaper, so that people will buy local cars.
For buying option.
So there's plus minus. So government may come up with different policy just to protect.
This will be near zero.
The domestic
scrap value
market. Do you all have a big hypermarket?
At the end of.
Do you all have a big hypermarket like
useful life?
Probably like IKEA or I don't know, Carrefour or something like that.
Yes, sir.
Do you all have? What is it called?
SM, sir.
SN is it?
Yes, sir.
Do you know there is no such hypermarket like that in Singapore?
Something we discussed earlier before break.
The Singapore government does not allow big
hypermarkets. If you buy, you can
to
claim tax relief on
in their
capital
country.
allowances.
Why? Do you know why?
And then any relevant?
The reason is, what's that? If
Maintenance
you open up a
costs
hypermarket, big hypermarket, they will sell goods.
It's tax relief.
They will sell their product at a very low price.
Any relevant maintenance costs and
it's very difficult for small shops to compete.
Will there be any?
In Malaysia, we had a lot of provision shops, a lot of small businesses.
If you
shops.
buy, maybe
the
you have to maintain the machine.
Big hypermarket.
So you may have to spend some money
opened up in Malaysia.
So
lots of these shops
is
closed up because they cannot just compete with
so
them.
You can also
their prices are so much cheaper because they buy in bulk. So they get bulk discount. They buy directly from the distributor. No middleman. So they sell at a very low price.
Select
they just cannot compete. So that is one of the reasons why Singapore does not allow
cost.
large corporations to
Lowest cost.
open up in
Please note,
what do you call
you're comparing
Singapore.
leasing costs.
Okay. Right. So that is
Versus
on
what?
a financial
Buying costs.
okay, environment.
Costs. Okay, financial environment. Hence, okay, I'm gonna take this opportunity to start off on investment appraisal because
Must be in what?
as I said,
In
it's a
negative.
very big topic.
You
2
cannot have
hours
a
is not
positive. If you have a
enough.
positive
I'm
figure,
gonna do
something is wrong somewhere. You made a
investment
mistake.
appraisal, just a basic
You are
stuff.
calculating costs.
Can I proceed? When you calculate the buying costs or leasing costs,
Yes, sir.
Sir.
okay, your answer must
Basically,
be
there are
negative. It's
two
not negative
ways.
if you made a mistake. Okay, the basic methods. So that is buying and leasing. We call it non-discounting. The other investment, specific investment, I'm going to focus more on the discounting methods later on. Lease or buy. So let me just touch a little bit on non-discounting methods. The other one here is your capital. So of course, your discounting methods is the most important one. So what is the difference between capital rationing? What do you mean by that? This is here limited takes into account capital, takes into account time, value of money. What do you mean by takes into account time, value of money? PV. Can you say today's $1 is the same as next year's $1? Or can you say today's $1 is the same as last year's $1? Capital rationing.
No.
No, you no,
Definitely no. You do not have the same
purchasing power.
Last year for $1 you can buy a cup of coffee. Today, the same $1 you cannot buy the cup of coffee because the cost of cup of coffee has gone up to $1.20.
Single period means
So discounting method takes into account time value of
1 year, multiple
whereas
period.
the non-discounting ignores what's that?
More than
Time value of
1 year.
money.
So this one
that is why discounting method
not
is
in
more
FM,
relevant.
so you don't worry about it. So we focus on this.
So two things
Single
that you'll
period.
be looking at here,
Okay,
which is your
so this will be relevant
simple
for FM, for single period.
payback period.
So you only have limited funds just for one
and
single period.
ROI, return on investment, or
Okay.
ROCE,
Now,
return on capital employed.
question here is why there is a
So payback period is based on
why there is a
cash
capital
flow. This one is based
rationing.
on what?
This has come up 2-3 times in exam, couple of times.
Accounting.
Why
Profit.
there is a capital rationing? What is the reason for the capital rationing? Why? Due to
Okay. Because it is accounting profit,
external
it is
factors.
easy to what?
Due to
Easy to what?
internal
Compared to
factors.
cash flow. Accounting profit is easy to what?
So external factors is called
Easy to
hard capital
manipulate.
rationing. Internal is called soft.
If you have $10 in your
Capital
wallet, it's $10.
There's a hard and soft
cannot manipulate.
capital rationing.
That's the truth. But when you say accounting profit, profit is stated on a piece of paper. So it can be easily manipulated.
Okay. Hard
So
capital
if you look at
rationing,
a
external
simple
factors,
payback
what
period.
it means by here, unable to raise,
What is this?
what's that?
Measures what?
Finance
How long?
from third party,
It takes to
unable to raise finance. Why?
recover what?
Company have what?
Initial investment.
High financial risk.
Yes. Sorry.
Company have a high business
Measures how it takes
risk.
to recover initial investment.
No security.
Short payback.
Is it?
So nobody wants to provide. finance.
Period means what? High risk or low
That's a
risk?
soft capital rationing.
Low risk.
No risk.
Management
Yeah, it's considered as low risk.
impose okay,
Considered as low
own
risk.
capital rationing. Why? So question has come up in section C, theory part, subjective part, where you have to compare payback period with NPV, payback period with ROC.
Can dilute.
What is the problem? Director says, no, you must invest a project
Shareholding.
based on payback period.
Why?
Debt
Finance.
finance is the director's comment acceptable?
Can increase.
Directors evaluate projects based on payback period.
Financial risk.
Evaluate.
So they don't want to take
directors,
unnecessary
investment
equity,
appraisal
unnecessary
techniques.
debt finance. They prefer to
So what are the major
use whatever money they have. They don't like to borrow. They don't like to get money
drawbacks?
from other
You must know.
shareholders or
Simple
new
payback
shareholders or
period has a
investors.
very
They rather
serious
use whatever
drawbacks.
money they have.
Number one, does not
Alright.
evaluate what?
Why?
Entire
To create
projects.
healthy competition.
Ignores cash flow.
To
After
create
what?
healthy competition. That means what? Only, what is that?
Payback period. So it's kind of related to note number one lah. Okay.
Only best projects.
Does not provide a measure of
To
what?
create healthy competition. Only best
Return.
projects are chosen.
Profit is a measure of return.
Right?
Return on
Only the
investment
best
is a
projects.
measure of
Because you
return.
have a limited fund.
NPV, positive
You
or
will not
negative, is a
simply do
measure of
any
return.
project. You
But
will only
payback
do the
period
best projects.
It's not a measure of return. Payback period just tells you
If
how long
you
it takes.
have
2 years,
unlimited funds,
2.3 years.
what will happen?
Huh?
You will end up
4.6
choosing
years.
all kind of projects.
So it just
So
tells
with
you
this,
how
you
long.
only
So it's
do
not a measure of return.
the
It
best
doesn't tell
projects.
you whether it's profitable or not profitable. So it does not provide a measure of return. So it does not
Okay,
evaluate.
Solution. What is an optimal?
So useful for what?
Investment
Useful
plan. What is the optimal investment plan?
to carry out what?
So it depends
Initial
on what?
tests.
Depends on whether the projects
Before
are
what? Detailed
divisible projects
investment
or non-divisible.
appraisal. Before you do a very detailed
Project.
investment appraisal, before you know.
So what do you mean by
you-
divisible
before you-
projects or
what do you
non-divisible
call,
projects?
sure you are really interested or not, whether it's worthwhile or not. Do a simple test first. What test?
Divisible project
Calculate
means
the payback period. If the payback period is 7 years,
Can
you may say,
invest
oh, you're too
in
long lah. Don't waste your time. Reject. Better reject now. Payback
proportion.
period 3 years. Looks interesting. Okay, let's do further analysis.
Partly.
Let's find out whether it's really worthwhile or not. You see? So a simple payback period can give you some initial
cannot invest
testing
in proportion.
to consider or not to consider. But it is not a
Cannot
technique for you to make a
invest
decision.
in
So simple payback period is not a criteria
proportion.
to make a decision
Huh?
to accept or reject.
That means
You understand
either
what I'm trying to say?
0%
or not? You don't
or
say, hey, let's accept the project because the
100%.
payback period
Whereas
is 2
here,
years.
example,
It's wrong.
10%
You cannot make a
or
decision like that just
20%
based on
or
payback.
80%.
Okay, the other
Anything,
one is
up to you.
ROI, or sometimes known as ROCE. So how you calculate, it can be,
So if you
profit.
invest
Most of the time is average
40% of the project costs
divided by
NPV achieved investment
will be on
100%.
pro rata basis.
Okay,
That means
so this
40%
average
of
here.
NPV.
You have to be careful.
So let's say the project is 100 million. You don't have 100 million.
Closing.
You only have 40 million. So you can invest 40 million, but you will not get the full NPV. You will only get 40% of the NPV.
So check the question.
So let's
Read
say the
question.
project is 100 million. The cost is 100 million. NPV is, let's say, 5 million.
Whether you are using average profit.
So when you invest
investment or
100
some
million,
other profit,
sorry, when you invest 40%, which is 40 million,
it's a base.
you will only get 40%
percentage.
of the 5 million, which is 2 million.
So therefore, what is that? Is it relative
On a pro
measure?
rata
Your answer will be
basis.
percentage. Relative measure. So what is a good part of a relative measure?
So if the projects are divisible, decision making, what do you do?
Useful to what?
Calculate what?
Compare performance of what?
Profitability
Different size.
index, PI.
Useful to compare performance of different size.
Rank the projects.
So project A 5 million,
Based
project
on
B 2 million.
PI.
Of course A is bigger than B. So you
So
want
project
to compare and make a decision, means you cannot look
with
at
what?
the profitability
Highest
in terms
PI.
of dollars and cents. Why you cannot look at
Ranked
profitability
first.
in terms of dollars cents? Because the size is not same. Project A 5 million is much
For
more bigger
investment.
than project B. So if you want to compare to see which is most profitable,
Okay.
you look at what?
So how you calculate PI? You take your
You look at the percentage. Same like the pass rate lah.
NPV of the investment
When you want to
divided by
compare
the
last year students with this year students, do you say last year 20 students passed, this year 25 students
investment
passed?
cost.
Do you say like that? No, isn't it? You do not compare in absolute measure, you will compare in relative measure. You don't say 20
If
students
there's non-divisible,
because the class size will
so
be different
decision making.
each year. So you must use relative percentage, relative measure in percentage. How many
by
percent?
trial and error.
Okay.
So
So even
what do you mean by
this
trial and error?
is a bit better than
Here you
this
don't
one, but
make-
it has also key
You don't calculate
drawbacks.
profitability index by trial. That means what?
What are the key drawbacks?
Find a combination
Number one, as I said earlier, based on what?
of projects.
Accounting, profit.
Find a combination of projects
So can be what?
within the
Manipulated. Number two,
limited funds. Within the limited funds, whatever money that you have within the limited funds, find a combination of project within the limited funds
what's that?
that
As I
can
said-
achieve, what's that?
Does not
Highest
maximize
NPV.
what? Shareholders' wealth.
They can achieve the highest
Ignores
NPV.
time value of money.
So please note,
Ignores time
What's
value
that?
of money. It's very important for shareholders.
they can.
They take into account time value of money. Right? It's very important. That's how you maximize. You see, when you say maximize the shareholders' wealth, means the
Can
shareholders
have-
must be able to buy more and more and more things.
Unused
Right?
funds.
Let's say your salary is $1. The $1 today you can buy a cup of
Balance.
coffee for $1. Let's say that.
So
Very simple.
can have unused
Okay? Your
funds.
salary is $1.
Okay.
And for $1 you
Balance.
can buy a cup of coffee today. After 1 year, your manager gives you increment. He says, okay, you're a hard-working person. I give
After
you
choosing-
salary $1.20.
Of course, when you look at $1.20, you get 20 cents extra, 20% extra, you'll be very happy. Yay! I got 20 cents extra, 20%. My boss is very good. He gave me extra. But when you go and buy a cup of coffee after 1 year, a cup of coffee now costs you $1.25.
You should not have any
$1.25. So can you buy the cup of coffee?
Should not have any.
Obviously, no. You cannot buy the cup of coffee.
Funds.
In fact, you became poorer.
Balance.
Not richer. You don't have the purchasing power anymore. Even though your salary now is $1.20, but the cup of coffee is $1.25. So the increment of 20%.
Should not have any funds balance after
in fact, you became poorer.
Investment.
So when you say maximizing shareholders' wealth means it must take into account time value of money. That means, let's say the cup of coffee now is $1.10.
Right, so that is.
Then you can say your wealth increased by 10 cents.
Rationing.
Why?
So whether you want to use profitability tax or trial or
buy
error,
the same
you
cup
must.
of coffee which will cost you $1.10 now.
You must check.
So you still have 10 cents in your hand.
Whether
That is what is going to increase your purchasing power.
Okay, the third one is your asset.
Hand, you are able to buy more things now, increasing your purchasing power. That is what you mean by economic growth.
Replacement.
You must be able to buy more things.
Cycle. Asset replacement cycle.
You must have.
So what is asset replacement cycle?
So those of you who are working,
it's basically about
when you get bonus or when you get increment in your salary, ask yourself, does it increase your purchasing power or not?
Should.
So you have to take into account time value of money.
How often should an asset be?
You have to take into account time value of money. So that is the problem with
replaced.
ROI, ROC is a very simple relative measure, but does not take into account time value
every
of money.
3 years, 4 years.
So the discounting method is so before I look at, I need to know
question. You can have two types of scenario.
When you talk about interest, there are two types of interest calculation
with different.
What is the two types of interest calculation? One is called simple interest.
Useful life.
One?
Or
compound interest.
Compounding. 2 or more competing assets.
Under compound, money
with different
grows what? Faster. Money grows faster.
Useful life.
Because interest will earn interest. Under compound, interest will earn interest. Like the first example I gave you.
So,
when we talk about present value. You see?
Toyota.
So when you say 9%, you calculate based on 0.
So you can replace
9% was based on 0.7
every 3 years.
That means the interest is earning interest again.
4 years.
This is compounding.
5 years.
Is very simple. There is no interest earning that.
Here example.
Okay. Interest is only based on principal.
Your 2 options.
Compounding is based on the balance sum. Money grows faster under compounding. So year 0.
Replace every 5 years.
Year N, let's say. Right.
Toyota car. Or
so
you can buy a Honda car.
Say dollar. How much dollar you will have in the future?
And this one you replace, let's say, every.
Now this is
4 years.
So you're still comparing 5 years with 4 years. Future. So if you want to know how much, so whether you want to buy a car and replace every 5 years, or you want to buy another car and replace every, this is what you call 4 years. So we are still comparing with the 5 or 4 years. So it can be just one car based on
different useful life.
So if you are calculating future value,
you can compare with two competing cars to see which is most beneficial.
But if you were to look at the same scenario,
so whether it is one car or a competing car, the key assumptions are what? What are the very important assumptions?
If you go this way, backwards,
efficiency remains.
I have $1 here. X.
Same.
How much will it be here?
Each year.
So again, we are calculating the present, future.
Benefit from.
So here I calculated the future.
From competing assets.
I'm calculating the present. And this is what you call?
Same.
What is that?
No difference.
Discount.
So whether you use Toyota car or whether you use
technically it is what?
Honda car,
discounting is technically
the benefit is
what?
the same.
Is the opposite
efficiency
of?
Is the same. Performance is the same.
Is opposite of?
The asset
compounding.
Will be
So whatever future cash flow will be discounted to present value.
In perpetuity. So
So in my example,
that means it will be, if you're gonna,
year 5,
if you decided to replace the car every 4 years, so you will do it every 4 years for forever, for the rest of your life.
At 9%.
These are the key assumptions.
0.
So, what are the relevant cash flows?
Hold on. 0.65.
Relevant cash flows will be, of course, costs and scrap value of the asset.
So you just take $1 times 0.
Sorry, hold on.
65. So if it's here $5, how much here? What do you do?
Cost of the asset.
You take $5 times what? 0.
The one is the scrap value of the asset for
Which will give
each.
you how much?
3.25.
So that is the discounting process.
Cycle value.
So that is why we have to use the table. The table gives us a very fast calculation. For every $1 at 9%, 5 years is 0.65.
Scrap value
$5 means you just
increase
0.65. You get 3. That means
as the asset
has 3.25 now.
Gets
at
what?
9% per annum in year 5.
As the asset gets old, yes or no?
Correct?
When the useful life
so
is
that's the
increased,
basic understanding of discounting.
if you sell the asset
So
after 3
in 2
years
weeks' time,
compared to selling the asset after 5 years, of course the scrap value for year 5 will be lower than the scrap value for year
NPV and all that.
3.
As I said, please read up.
And then you also have what?
Your work. Go
Maintenance
through your
costs
before you join my webinar on the investment, because I'll be doing a lot of
each year
in the 2 hours. So if you have any doubt, it's the best time for you to ask questions.
Tend to increase.
So you have to do your work first before you join my webinar.
As a useful
life.
life.
2 weeks. So please go through everything in detail.
Increase.
It's a
So
very
if
important
you,
topic. As I
of
say,
course, the first year the maintenance
99%
cost won't be so
confirmed
high.
to come out for
But
your
as you
exam.
keep on, increasing, as you keep on using the asset for longer and longer and longer time,
Today, is there any questions
obviously,
you want to ask
what
me?
happens? The what do you call
Ladies and gentlemen.
maintenance cost will be higher and higher.
None
So
so
decision
far, sir.
making. What's that?
Yeah. Thank you very much. Right.
Choose the
Andrew and Nicole.
lowest
Eugene.
EAC.
Everybody. Thank you very much.
What's the
And,
lowest EAC? EAC is what?
Can Lin.
Equivalent annual
Also, thank you.
cost. So how you calculate EAC?
Alright.
We find out
Good night.
NPV
Take care.
of
Thank you,
each
sir.
replacement
Thank you,
cycle.
sir.
Thank you. Thank you.
divided by
Jill.
Annuity factor